Let's dive into all things jobs now with ADP chief economist Nela Richardson. Nela, always good to see you here. Disappointing report on the headline. Is this a sign that the Delta variant is having a greater impact on the economy than a lot of folks think?
You know, the Delta variant is just one part of the uncertainties that are currently characterizing the labor market. There are other bottlenecks that were there before the Delta variant really became part of the national attention, including childcare and the lack of childcare over the summer, bottlenecks when it comes to the timing and matching of hiring, a shift to more long-term workers making up more and more of the unemployment roles. And I would have to say this hiring mismatch with firms all wanting to hire the summer while consumers and workers may have benefited from transfer payments or generous unemployment payments that keep them off payroll until the fall. So all of these things are kind of coming together to show up in a very uneven but still progressive labor market recovery.
You know, Nela, in today's report, I'm struck by what we see in construction and manufacturing, just a combined 9,000 payrolls added in July there. And given what we've seen in some manufacturing data where employment improved last month, what seems to be holding back the appetite, at least, for hiring in those sectors?
I think the appetite is there. I think the meal is missing. So right now, skilled workers have been in short supply, but this isn't a pandemic phenomena. And when it comes to construction, those in specialized trade have been missing in action for the past 10 years. It's one of the reasons why housing has been in such short supply. In manufacturing, you're still seeing that missing skill set dominate in terms of hiring. So this isn't new. It's just been amplified by the pandemic. We think that manufacturing and goods sector in general is holding up pretty well, given the labor shortages and anecdotal evidence around that, and also the supply chain bottlenecks that are ongoing because of the pandemic. So again, that unevenness continues, but progress is being made.
Nela, is it also the problem here that employers perhaps are not raising wages fast enough to get workers back into the market? We had an announcement today from CVS raising their wages to $15 an hour by July 2022. On the paper, that sounds good, but should be $20 an hour to work in a CVS.
Right. So there is a limit to how quickly wages can adjust to meet current demand and supply dynamics. It's hard for companies, especially small businesses, to raise wages to attract new workers, because that also means they have to raise wages to retain existing workers. And if you're in a slim margin industry and you're still dealing with the effects of the pandemic on your revenues and cash flow, that could be a very challenging spot to be in. But we're also seeing at the same time that the prevailing wage may not attract the same quality of worker that was before the pandemic. And if you need any evidence, you can look at the overall number of people who are leaving their jobs to look for new ones. That's actually higher than it was before the pandemic. So there is a reassessment of work going on at the worker level. Wages help kind of narrow down those options pretty quickly. And so firms that are competitive right now are the ones who can adjust wages quickly. But over the long term, it's that skills match that's most important in retaining a high quality, productive workforce.
And Nela, I'm also struck by the seasonality that we can see in this report. And you guys have a chart that goes back over the last 12 months. And we saw a surge from July into September of 2020, back down, surge from March into May, and now back down. And I'm curious how you're thinking about the labor market as we head into the school year. That's been a big potential catalyst. Is that something that's on your radar as maybe helping to increase the rate of hiring, or are we likely to see another false swoon?
You know, seasonality is also conflated with the path of the pandemic. So a lot of the ebb and flow of the labor market can be attributed to the rise and decline of the case count. And so as we head into the fall, we're also heading into a fall that looks increasingly uncertain from a pandemic perspective, right when we thought that the case count was being put to bed, and definitively so. So even as we expect higher vaccinations to improve health conditions going forward, there's still some uncertainty. That is matched up again now with the fall, with the idea that schools would be back in session, that parents would be freer to look for work if the child care was in place and elder care was in place. But we can't also miss out of these structural dynamics. We're seeing a record number of business applications, for example. We're seeing new retirees and early retirees shape the job market, and then a lot of switching jobs, which we've already pointed to. So all of that churn is going to impact the fall labor market as much as it is the summer labor market.
Nela Richardson, ADP Chief Economist. Always good to see you. Have a great rest of the week.
Thanks for having me. Good to see you guys.
Mickey Drexler is credited with turning around some of the most well-known retailers in the game as CEO. You've probably heard of them, Gap and J. Crew. Now Drexler is back at the helm, leading specialty apparel retailer Alex Mill. The brand was co-founded by Mickey's son Alex Drexler in 2012. Joining us now for a look into the current state of retail is, in fact, Mickey Drexler. Mickey, good to speak with you here. So you're back at the top of the helm. You're back in the retail game, leading Alex Mill. Tell us a little bit about the brand and how it's been doing during the pandemic.
Well, we're doing actually quite well. We're a brand that's been around, run by my son for 6 years or so, as you mentioned. Pandemic kind of hurt all of us to a degree. We're fortunate that we only have one store. So with one store and online as a business, the business has been quite good. And I'm very happy with where we are and mostly with where we're going. The pandemic, we're going to open up our second store here on Madison Avenue. But we have a really cool store in Soho on Broadway and Mercer Street, 2 entrances. So, but we're doing okay.
What is it like working with your son so closely during the pandemic to try to build this brand?
Well, not easy, pandemic or not. But we finally reached a father-son agreement, and I was probably treating Alex more like, I want to say employee or an associate. He's my son. And I did learn that son comes first, and then employee, or well, I don't like the word employee, associate and partner comes second. So it's not been easy, but now it's been so much better. And then we have a third, Samsak, who was our third co-founder, who worked with me for over 15 years in my old companies. So, but it's okay. We're getting along well, and we're moving forward.
And Mickey, I'm curious how you're seeing, apparel trends right now. We've talked a lot on this program about, big public companies, big public retailers have seen a surge in their sales as people have started to reemerge back, into the world. What are people wearing now? What do you think people will be wearing on the other side of this? Will it be dramatically different from what was prevailing pre-pandemic?
Well, the pandemic, for all of us, we were up against like a snowstorm every day for an entire year. The real world will begin again in February of 2022 when we're up against normal figures. Everyone's comparing themselves to 19. Everyone's quite happy right now. I'm not in one of the big people I used to be in terms of a business, so it's hard to know. But I think clearly there'll be less sweats. In fact, unfortunately, we ordered our last order of sweats without figuring out that they would drop dramatically, and they have. So if anyone needs a sweatshirt, we have plenty of them. But I think people are going to get back to being normal in their dressing. I think clearly there won't be as much dress up, but khakis, jeans, back to the more uniform kind of dressing. And not wear anything because you're at home, although a lot of people are still home with a Zoom. So I think dressing up, we're looking at more suitings for men and women, but very, very casual suitings. And for us, mostly we look at good taste and good style, which is really important, of course. So, but I don't think, I'm not sure, but I think, online will continue. Companies are going to have less stores because they don't need as many stores. And there'll always be a business, but I think the best are going to win always. The ones who are good at what they do style-wise, value-wise, and nothing in that changes long-term, in my opinion.
What role do stores play in the post-pandemic retail sector?
Well, I think all of us went to store crazy worldwide. I think there's nothing like going into a store to get a sense of the business and the brand. So where companies opened up, I'll make up a figure, 250 stores, they probably need 100, maybe 125 stores today. That's a guess. No one will know until time passes in that regard. I do think, and I think if a shopping center or a mall or a street is compelling to visit, I think those are the winners in the business. You know, A+ shopping centers I still think will do well. I wouldn't want to be in the C or D shopping mall business today. And you just don't need as many stores as they used to have. You never did, by the way, because the amount of markdowns that are taken and discounting that goes on is beyond wild, always.
And thinking about the e-commerce, piece of it, Mickey, I'm curious what you make of, a lot of, the Walmarts, the Targets. They're all trying to open up to third parties as well. Everyone wants to be an Amazon of sorts, and I'm wondering if it makes the opportunity, more compelling or more straightforward for an independent retailer to, own and operate their own site, because that behavior is now ingrained in consumers that you go online first to really look for something.
Well, I think they'll always, it depends on what kind of brand or retailer you're talking about. We right now wouldn't join any of them. Yeah, it would be great for 1 week or 2 weeks maybe of, wow, look at the amount of people. But at the end of the day, Walmart and Target, great businesses, by the way, they're valued businesses. So for us, it doesn't work. But I think for most other value players, look, there's value, and then there's, I think, overpriced. And then there are businesses like ours that are very fair priced and don't take double markups. So I think it's smart to do it. I'm an Amazon family, but I get Walmart delivered to my home also. I'm not sure what's in the Walmart packages. I think a lot of it's in Amazon's packages. But we won't be there as a high-taste fashion company for sure.
No offense to Walmart, Mickey. I hope it's not Walmart apparel. That stuff is just not cutting it. They have not cracked the code on that, and they probably never will.
Well, I think you're right. And I spent a day there 2 years ago. And Target's pretty cool now. And Walmart hasn't cracked it yet. You're absolutely right. And by the way, if they ever do, they'll be dangerous. But they don't. And that's why we started, when I started Old Navy many years ago, I can't believe it's 25 years ago, I was inspired by Target and Walmart, and Old Navy's, been a success, hugely successful. For those people, every business is tiny, but I don't like that big anyway. Old Navy was an amazing and is an amazing business. Good value, fun, and style.
Mm-hmm. So Mickey, bear with me on this. So I've been following the Kanye West product drops pretty closely here. Not much has been released yet. Pretty cool round jackets, 2 different colors. But then I go into a Gap store and I still feel that disconnect. There is the Kanye stuff and the non-cool stuff in the Gap store. Do you think that eventually changes for Gap at some point because of his influence?
Well, I probably shouldn't say this, but I told him he shouldn't do the deal because it doesn't make any sense. My opinion, and my friends, I have a lot of friends at Gap still, but it doesn't work for someone like Kanye. He's not a corporate person, and Gap's a big corporation. And so I know the jacket sold out. They did $7 million on the one jacket overnight. No zipper, no nothing. I mean, try to be warm with no zipper. But
need the zipper.
They left out the zipper. Well, he's a smart guy, but he should have done it. And I don't think they should have done it either. And I hope my friend Mark's not mad at me. We'll see what happens. It's very, very hard culturally to do what he's trying to do. So see what happens.
You know, Mickey, speaking of Kanye, it makes me think of course, the Yeezy shoes and the sneaker craze that we've really seen in the last several years. I found myself, you know, as a millennial man living in a city, thinking I should care a lot about my sneakers in the time before the pandemic. And when I go on Alex Mill, I see things that will actually last over time. I look at some sneakers I bought in 2018. They look ridiculous now. What do you make of the streetwear craze that we've seen, you know, StockX, Goat, these other platforms, and where that fits into, you know, men's fashion today?
Well, I can't ever argue with what customers like. It might not be right for us. We have a sneaker. It's actually my biggest, this is silly, my biggest frustration. We have a sneaker called Babook, B-A-A-B-U-K. I found it 3 or 4 years ago. I went to Switzerland to visit with the owners of this tiny little company. We redesigned the sneaker. A few of us here wear it every day of our life, but we're not Nike, we're not Adidas, we're not New Balance, and it's very hard. What I think of them is, again, it's personal or business. I think it's wonderful for business. Personally, I don't, you know, I'm not into it, so I don't understand. I understand it, but what do I think of it? It's just a way to look new and not look like everyone else. And I don't really get it the way.
Mick, I can't help myself here. I've listened to a lot of your earnings calls through the years at J. Crew and at Gap way back in the day. What's your holiday season outlook?
What is it, what, holiday?
Yeah, what's your holiday season outlook? Is it just going to be gangbusters?
Well, I think for us, you know, it's really nice to be small-ish. I love the way our goods look. And I say that objectively. You know, we're a tiny little, we're not tiny and little anymore, we're getting bigger. But it's not about holiday, and never was for me about the outlook. It's always about how good are you at what you do? How good are your goods? And so the holiday outlook, this holiday will be great for everyone because we're up against the pandemic. It has to be great. And then the real world will start again. Everyone's so happy out there now, but just let's wait to see what normal looks like again and how it is to be up against normal.
What is your, before we let you go, Mickey, what is your favorite piece from your collection at Alex Mill?
Well, my favorite are the jumpsuits because that's for women mostly. We just started carrying guys. You always have to say your favorite is the one you can't keep in stock to a degree. I have personal favorites, but it might be we have some very cool chinos, but that's personal. And I only wear Alex Mill. This jacket, by the way, nylon and cotton. You're going to see a lot of this on. And our sweaters, I think, are incredible. But I sound like a retailer, you know.
Guys, jumpsuits. I have never seen one of those, but maybe Myles, Udland, maybe you and I. Oh, I see them right now on the website. That is that's interesting stuff.
I got to join the wait list, though.
You call me, I'll get you. They sold.
Face know the right people. Myles Udland with his first jumpsuit.
I got a 40 chest, 34 waist. So is that a large or medium, Mickey?
It all started because of a person on TV said, I want a jumpsuit. We made him a jumpsuit, and then we ordered a whole bunch, and it blew out. I'm just going to do it quickly. I wish I could find it. Well, hang on here. Here. Here it is.
Oh, that is right. That is for Myles. That's perfect. That's a Robin Hood trading outfit right there. That's wonderful.
Yeah, I think maybe a medium. Man, I'm right on. I need a Marge.
Well, I'll give you Mickey's email after this. We'll get it done. We'll leave it there. We could stay and talk to you all day. Mickey Drexler, it's good to see you. Thank you for the time today. Good luck at Alex Mill. We'll talk to you soon.
Appreciate it. Bye-bye.
Well, we saw shares of Tencent bouncing back in Hong Kong trade overnight after the stock plummeted on fears of a regulatory crackdown in the gaming space. The gaming sector, just the latest in the crosshairs of regulators over in China and increasingly here in the U.S. as well. So what is the key risk here for U.S. investors? For more on that, let's bring in Carson Block. He is Muddy Waters Capital founder and CIO. And Carson, it's great to talk to you today. It feels like we have seen one crackdown after another over the last several weeks. Started with Didi, we talked about the tech companies, then the education sector, now the gaming sector. What do you think is the motive here? Connect the dots for me.
Sure. So let me preface everything by saying that when it comes to reading the CCP tea leaves, I mean, who really knows? So I'm just giving you my best assessment. I think you have to look at this in two tracks here. So you have the industry by industry crackdown, whether it's on real estate, such as Evergrande and the leverage there, the cybersecurity with Didi Chuxing, or the education companies, and also Tencent as well, gaming. But I think that what actually is more important is this thread that connects them all, which actually is an issue that goes back probably 11, 12 years. And that is the issue, at least in the United States, with the fraud in the financial Chinese companies, the US government's increasing demands to be able to inspect the auditors of these companies. And I think what we're seeing now, since most of these moves are against publicly traded companies, especially companies that are public in the US, I think that what this means is, and understand, I'm reversing myself here. I always thought China would give at the 11th hour on auditor inspections. And the reason I thought that was because so many CCP officials have undisclosed stakes in these US listed China companies. So I figured, that they would exhaust our political will and then give on it. And, we'd be able to inspect the auditors and nothing really would be accomplished. But I think Xi Jinping has decided not giving on the auditor inspection. And I think that's because right now he has to play to this domestic audience of not being bullied around by the US. And I think he's also assessed then that it is inevitable that the US will delist the US listed Chinese companies, because if you look at this act that was signed into law in December of last year, it passed each House of Congress unanimously, and it requires the SEC to delist these companies. So I think that while you can see certain industry by industry moves here that are designed to improve things, I suppose, in the domestic front for Chinese citizens, the overall thread is, I think Xi Jinping is saying, look, US listed companies need to understand that they have to find an alternate way of accessing capital markets, come back to the mainland, come to Hong Kong, but your days in the US are numbered. So that's my best interpretation of what's going on.
So where does that leave U.S. investors? I mean, it sounds like you're saying that the Chinese side isn't going to give. The U.S. is going to continue to seek additional transparency from these U.S.-listed Chinese companies, which isn't going to actually happen. What about those investors who've put their money there?
Well, so the act that was signed into law, the Holding Foreign Companies Accountable Act, has a pretty long runway on it. I mean, clearly, Congress was not looking to, this was a bit of a kid gloves approach. But what I think China is doing here, and actually this is an important point that I should have made a moment ago, is with Xi effectively forcing companies to relist or exit the US capital markets over time, if Chinese companies largely get out of the US before the mandate to delist kicks in, then it kind of looks to Xi's domestic audience like Chinese companies left the US out of strength as opposed to being thrown out. So again, this is all, in my view, about playing to domestic politics. So what is the timeline that Xi Jinping is really imposing here on companies to get out of the US? That's impossible to say. Again, the Holding Foreign Companies Accountable Act, I think it's a 3-year runway. So for Xi, it's somewhere inside of that. Now, some of these companies will be able to relist in Hong Kong and have active markets. And so if you're a US investor holding shares in a company that does that, you should be able to, as we say, funge your shares and trade them over there. But in my view, the Hong Kong market does not have the liquidity to support a wholesale relisting of these companies. So I think your tier 1 US listed China companies will be able to find reasonable markets over in Hong Kong, meaning some liquidity, et cetera. It won't be anything like the liquidity in the US. But your tier 2 and tier 3 companies are going to have problems. Now, the interesting thing here, and now this is speculation on top of speculation, but that might mean that China will look to encourage, and there is precedent for this sort of thing. If you look at these companies that were acquired in 2012 through 2014 with financing provided by state-owned banks, like some complete zeros were taken private at real premiums with Chinese government financing effectively. I think that maybe you could start to see some acquisitions over time of these tier 2 companies by the tier 1s because there's not enough liquidity in HK. So speculation on speculation, but there might be an interesting long side play. Not something I'll get involved with, but just putting it out there.
Yeah, I mean, speculation on speculation. That's where our viewers' ears might perk up here in terms of what they should be doing, maybe to play it. And you're talking about risks in some of the bigger guys versus some of the smaller guys. There's also the ETF way to play this, I suppose, if you really wanted to. Fundstrat was out with an interesting note kind of mentioning a potential inflection point on KWEB, kind of the China Internet ETF here. And when you do look at that, I mean, down 54% since March 31st, the S&P 6% gain over that time frame. I mean, when you're looking at this, obviously you're talking about speculation on speculation here, but it sounds like you're mentioning that there could be less risk to play the bigger guys here that have also been beaten down, but have also seen investors shed them, Cathie Wood among them. I mean, what would your advice be to maybe an investor who does want to take the other side here and maybe jump in now?
Well, look, I mean, when you say less risk, I suppose it's all relative. I'm of the view, and I have long been of the view, that substantially all of these companies have problems with their financial statements to at least some extent. So if you look at it through my worldview, you're talking about financials that are probably, have issues in many cases. You're talking about this variable interest entity structure, VIE structure, that we didn't mention this earlier, but the PRC government is putting this up for review as well. And that's the structure by which almost all of these companies that are listed in the US have gone public in the US. And it applies to, I think, pretty much every internet company. So there are questions around the legality there. I do think that the end game is to relist these companies in Hong Kong or domestically in China, but that's also a risk right there. If you're thinking on the US side, hey, I'm going to play this, I want to be able to fund my stock. If the relisting occurs in mainland, I mean, you really have to figure out whether your broker is going to allow for that. So I do think that the Chinese government was a bit shocked by the reaction to these moves in the markets. And they're trying to mellow it out. I think they want like a nice glide slope down as opposed to this. My kind of quip was, I think that too many CCP officials lost too much money too quickly when these things dropped. But it's risky. Of course, I come from a viewpoint where I've long felt that these are toxic securities. So take what I'm saying with a grain of salt if you want to be on the long side. But I just feel like there are lots of embedded risks here, and there are a number of unknown risks or unknowable risks as well.
Yeah. Well, I mean, let's shift from unknowable risks to maybe known risks. And one name that has been caught in kind of, shining a light on some of the known risks in the market. We're seeing shares of Robinhood pop quite a bit today, halted for volatility and a lot of that. I mean, we saw kind of short sellers get a lot of flack here in the GameStop meltdown. And now you got Robinhood up 30% and halted well above its IPO price at $38. I mean, as a man who's played the short side of this, what do you think about the moves there and what might you be looking to do on a move like that?
Well, I mean, trying to decode moves like that or volatility like that is, there's no fundamental way to look at that, right? Obviously, Robinhood exists and its business model is based on payment for order flow. So is there a regulatory risk here? I mean, there is a risk that payment for order flow will be reined in some way. I'd be surprised if it were eliminated. The HFTs that provide the payments to Robinhood will tell you that, hey, we must improve price, and we do improve price. But the flip side of that argument is, well, do you improve price as much as you could, or are you making this nice little spread there? And look, it's a very difficult, now we're talking US politics really, and it's a very difficult situation to foresee, especially because there's so little understanding of how this stuff actually works. I mean, it's a little disheartening. It was a little disheartening watching these GameStop hearings and, hearing various Congress people try to discuss what happened, and they clearly have no handle on how markets work. So is there a chance that they go and do something bizarre? I mean, in the absence of people who really know what they're doing, yeah, there's a chance. So again, I'm going to punt on this one and just say, state the obvious. There are risks there with Robinhood, but I don't know if PFOF is the wave of the future or if that's something that's going to be reined in.
Carson, finally, going back to the risk from the Chinese companies, I mean, it sounds like you're foreseeing here a potential decoupling, if that's the right word, of financial markets between the U.S. and China. And ultimately, what does that mean for the capital markets here in the U.S.? I mean, sure, there are significant risks involved with these companies, but you've still got dozens of Chinese companies that have come to market in the U.S. this year. What does that ultimately mean for the U.S. exchanges?
Well, we've heard the word decoupling used for several years with respect to the overall economic relationship between China and the US. And to be clear, it's impossible to completely decouple. So it's degrees of disengagement. I've been making the point for a few years that the capital markets were really the only high ground that had been left unscathed by this broader trade war or these broader issues, economic, political issues between the two governments. Well, that's no longer the case. It's no longer high ground. So I think that from the Wall Street perspective, the perspective of the banks and asset managers, they're not liking this because they want to continue to sell the dream to US investors and make the fees associated with that. I do personally think it's healthy if less US retail money and pension money is put into these things. But on the other hand, capital is mobile. And at least at the institutional level, if there are fewer US listed China stocks, then large fund managers will beef up their Hong Kong offices and Shanghai offices some more, and they'll be trading from there. So I don't think this will really scale back the availability of China-based financial products for US investors much. It'll irritate the banks, and the banks tend to get outcompeted in Hong Kong often by local banks, and there's real fee compression there. So for banks who make a lot of money on the IPOs and secondaries of these China names in the US, probably the halcyon days are over.
I want to switch over and check in on the action in the crypto space after SEC Chair Gary Gensler came out swinging with some updates on how he sees his agency stepping up regulations on tokens and lending platforms, not necessarily shaking up the prices here. Ethereum and Bitcoin both up today. In his thoughts, though, presented at the Aspen Security Forum, Gensler hinted at perhaps approving a Bitcoin ETF, even if it were limited to cash-settled CME-traded Bitcoin futures. So that might be a positive in some eyes. But the negatives, some people are pointing out, were focused more on pressure to label a lot of the other cryptocurrencies outside Bitcoin and Ether as securities. In a corresponding video on his Twitter, Gensler says it all boils down to investor protections. Take a listen.
I think that moving forward, promoting investor protection is not only good for you and for anyone who would consider investing in these assets. I think that it's the only real viable path forward for this nascent technology. See, at the heart of finance is trust, and trust rests on investor protection. And so that's what the SEC has to do with crypto, investor protection.
Shout out to the production value on that SEC video. I kind of like what they're doing there. But joining us now for more on what it all means, happy to bring back on Caitlin Long, CEO of Avanti Bank, one of the few licensed and regulated crypto banks in the space. And Caitlin, I mean, there's a lot to dig into when it comes to not just what we're hearing from Gary Gensler, but also what Congress is trying to do here. But we'll start with what we heard from the top of the SEC yesterday. I mean, what jumped out to you about maybe clarification on either the Bitcoin ETF that people have been waiting for there, or maybe more pressure on things that aren't Bitcoin?
Oh boy, yes, there's a lot going on, and Gensler is a huge part of it. I'm surprised he hasn't acted more up until this point. He's been in his role now for several months, and if you go back to his confirmation hearings, he was asking Congress for clarity. And what came out of yesterday's speech is that he's taking some positions in spite of the fact that Congress hasn't acted. So there's a jump ball going on. Is the SEC going to interpret its authority more broadly and start taking enforcement actions? Or is the SEC and, of course, other agencies in Washington going to wait for Congress to give them instructions? But very clearly something's happening. And I must say his video is interesting because consumer protection is at bottom one of the big concerns. There are bad actors in this sector. There are institutions that are doing things that, had they registered onshore in the United States, would be considered illegal and they would have been shut down already. But they're operating overseas, offshore, and in many cases actually serving Americans.
Yeah, it's interesting because you talk about maybe what they can do without getting more powers here from Congress. And one of those is kind of labeling what is a security and what's not. And he kind of waded into that. He didn't want to get into specific tokens, but I just want to read what he kind of had in his prepared speech there on that topic. He said, folks buying these tokens are anticipating profits. There's a small group of entrepreneurs and technologists standing up and nurturing the projects. I believe we have a crypto market now where many tokens may be unregistered securities without required disclosures or market oversight. This leaves prices open to manipulation. This leaves investors vulnerable. I mean, that is kind of what you're talking about here, investor protections. But there's a lot out there beyond Bitcoin and Ether. And you think about the exchanges being impacted here, maybe what you guys could offer being impacted. I mean, talk to me about how big that is and how hard it is for people to agree on what is a security and what's not.
Well, it's so interesting because the SEC almost 2 years ago put out guidance that was supposed to clarify this, and it's clear as mud. And the industry has been saying, we really would like to have clarity because we want to know where the guardrails are so we can stay within them. In most cases, the compliant actors are interested in staying within those guardrails. And that was one thing I disagreed with Gensler's speech yesterday when he said this is clear. It is not. It is clear as mud, and it does need to be further clarified. And what's happened is the SEC has taken the stick approach as opposed to the carrot approach, which is to use enforcement actions and sue the issuers of these tokens that may not have clarity. And instead, what the SEC should be doing is enabling the innovators who are trying to protect consumers and are not trying to defraud anyone by providing enabling guidance. And that is not what the SEC has done.
So there may not be more clarity right now, but it does give us a little insight into Gary Gensler's thinking. And this morning we heard him say that, look, if you look at the crypto exchanges, they're just not under the same regulatory regime like a New York Stock Exchange, for example. I'm just curious if you think that they should be. Should they be treated as the same, or do you think there are separate tracks that need to be pursued?
Well, for exchanges in particular, there is really no regulatory regime for them. And again, most of the ones that are actively trying to do right are asking for clarity. They're not trying to evade the law. There are some offshore, of course, that are, but most of the onshore ones are not, and they do not fit within existing broker-dealer rules. We saw Chairman Powell testifying at the House Financial Services Committee a few weeks ago, for example, say that one corner of this industry, which is called stablecoins, stablecoins are US dollar equivalent tokens, and that they should be either regulated as bank deposits or as money market funds. But the problem is they don't fit within money market funds right now. The Federal Reserve has the ability to fit them within bank rules right now. They don't need Congress to act. It's very interesting that the Federal Reserve has not done so. They're not eating their own cooking. They're not living up to their own words. But the SEC, I think, does have its hands tied more than the Federal Reserve does on going ahead and saying, yes, here's how exchanges should be regulated. I think both the SEC wants to do that and the exchanges are expecting it. The problem is it doesn't fit within the existing laws and they need Congress to act. And we see what's going on up on Capitol Hill. It doesn't seem like anything's going to happen anytime soon.
Yeah, in that appeal for powers, he kind of laid out also a focus on not just kind of the tokens themselves, but now the institution, the crypto platforms that are kind of lending and allowing people to tap equity in their crypto holdings, and we've seen pressure mounted on some of those other protocols too. I mean, when you look at that space, did that catch your eye for something that maybe Gary Gensler would have high on his list of things to talk about, and maybe the issues that we've talked about, you and I, before, when it comes to those lending platforms not necessarily having any oversight there either?
Oh boy, that was the clearest shot fired, if you will, in Gensler's speech. In my view, there was a one-line reference to crypto lending platforms, and it didn't mince words. It said if crypto lending platforms are engaged in securities activities, they are running afoul of the law. It's interesting because we have seen enforcement actions by state securities regulators. I think now we're up to 5 states in the last week or so against one of the crypto lending platforms in the United States. But the SEC itself has not gotten involved. And yet Gensler had that one line in his speech. It does seem that there's coordination happening among the regulators. It is worth noting, though, one of the things that I think is difficult for folks who haven't been around and don't have the proverbial gray hair to understand is that the SEC has 5 years to go after bad actors here. They can take their time, whether you think that's fair or not. That's what the law is. And in the case of the Ripple lawsuit by the SEC, it took them 8 years. And the reason that they kept going for 3 years after the statute of limitations expired is that they had apparently agreed with Ripple to toll the statute of limitations to give themselves extra time. I actually think they need to act. I don't think those kinds of behaviors are helpful. To sue someone 8 years later over something that might actually be a valid dispute. The law is not clear in some of these areas. But the SEC, just because they have not acted yet, it absolutely does not mean they won't. I think they will. They take their time and they get their ducks in a row first.
I think that's a good way to wrap here with the last question. And, I guess this might be veering a little bit outside of, what we normally ask you about, which is just kind of the price moves, just because of what we're seeing, Bitcoin and Ether seeing a pop. Of course, that's kind of been settled when we think about how the SEC might look at them as not securities. But it's interesting to see the rest of the tokens and the rest of the space still in the green as well. And we know they're kind of linked. But if anything we got from yesterday, it would seem that they shouldn't be linked. And I guess, the question there would be what you make of the moves that we're now seeing in kind of investors, maybe putting the weight on what you just said, that maybe they take this to mean we're in the clear here because the SEC hasn't done anything yet. So maybe it's going to be fine.
Well, I think some of it is in the price. It's hard to say how much, but it is true that Washington, D.C. has been telegraphing a big regulatory crackdown. It actually started on the day that Tether released its reserve asset allocation back in April, which, by the way, was the peak in Bitcoin's price. And at the time, I said that's not a coincidence because a lot of the big smart money at the time, you saw analysts telling their investors, get to the sidelines, there's a crackdown coming, and wait until it happens and then get back in. And indeed, that's kind of what the price action has telegraphed. But I think more interesting than the price action is the volume. The volume has collapsed as it's clear that certain of the intermediaries in the sector are definitely in the crosshairs and others are more likely to be clear. But again, until that all shakes out, I don't expect the volume to come back. But the price action, a lot of it is a function of scarcity, and that has nothing to do with regulators at the end of the day.
So many variables to walk through here. Caitlin, it's always good to have you break it down for us. Caitlin Long, Avanti Bank and Trust founder and CEO. Thanks so much for joining us today.
A mixed earnings report from Corsair Gaming this week. The company reporting strong sales growth, also reiterated its full year outlook, but adjusted earnings per share came in below estimates. Joining us now is Corsair's founder and CEO, Andy Paul. Andy, good to see you back on the show again. We all agree you have one of the coolest backgrounds we've seen in quite some time. So fitting for a video game equipment maker to have that background. I know that you're attributing the earnings per share shortfall to higher logistics costs, but I'm wondering if you could break down for us what those costs are and how long do you expect to see them remain elevated?
Yeah, well, look, this is a good point. Firstly, this is really a short-term issue, right? We've got a situation where there's the supply chain's a little clogged up. And, there's a tough time getting containers, but this is a short-term issue. This will all be resolved by the end of this year, I think. So, we tend to look at this as a long-term investment. And I think that's the way investors should really look at it. I'm not, to be honest with you, focused on quarter by quarter, earnings, whether we're getting 99% or 101% of the analysts' consensus. That's really the last thing. What we're concentrating on here is being right in front of a massively growing market and bringing great products to market. So that's really what I'm focused on.
Andy, let's talk about something else that has been impacting the business and just the industry at large, not just yours, and that's chip shortages. We've seen this impact so many different fields. Automakers, for example, have been squeezed right now because of those shortages. How has that been impacting Corsair? I hear what you're saying about some of the logistical issues and supply chain issues being short term. Are you still seeing that as well with some of the chips?
Well, we certainly do. It's been a tough year to keep up with the demand. As you probably know, the demand for gaming equipment, gaming gear has exploded over the last few years, and even more so with people spending more time at home for the last year. So that's definitely stretched the supply line, and a lot of our flagship products that have high semiconductor content have been tough to keep on the shelves because the demand's been so high. Again, that should resolve itself with time. Right now, we've got a pretty good inventory position. And so we're looking forward to, the next couple of years, we can continue to bring some of these great products out.
And I'm wondering, it's sort of like a 1-2 punch for companies like yours across a lot of different industries. Andy, when you look at the delays we're now experiencing at the ports, which is one of the reasons why we're seeing higher prices and inflation pick up, how impacted are you by what's happening at our ports and with backed up freight?
Yeah, it just makes the supply chain longer. So, what used to take us 6 weeks to get a container from Asia into the US or Europe now takes 10 weeks. And so once you understand that and plan around it, it's okay. But certainly there's more ships on the ocean. That's more inventory. We've got a good balance sheet now, so we can afford to carry more inventory. So all of those things, again, are short-term problems that have to be adjusted to. But it doesn't really affect the overall business that much. It just gives us a couple of short-term hiccups.
I'm curious to know, because the pandemic, we saw obviously everyone staying at home in lockdown, obviously a big boon for the business as so many folks were instead playing video games. But now that trend is starting to reverse just a little bit as we see folks starting to travel again and leave their homes and go to restaurants and movies and other outdoor activities and events. How do you see that impacting the company and the business going forward? How do you see that impacting demand? Or are you anticipating perhaps that as the Delta variant continues to surge that, folks are going to continue to stay at home and keep playing some video games?
Well, yeah, so it's not a digital yes or no. I mean, people aren't playing more games now because of COVID. Certainly, this has been a long-term trend, right? I mean, I've been looking at video game number of gamers, over the last 10 years, and it's steadily going up. Obviously, a slight acceleration last year, but it's not as though people are going to come away, start going to restaurants and stop playing games. What's really happening here is that the amount of games that people were playing last year obviously stepped up, the amount of hours played, and that's increased everyone's skill level. So now you've got a lot of people that are much better at playing whatever game they were playing, whether it's Call of Duty or Valorant or whatever. Once you get better at a game, then you start looking for equipment. So what's really happened is we've sort of had a big surge in activity that's now starting to see a surge in people wanting to buy better keyboards, better mouse, better gaming PCs. And that's why the demand's so high. So I don't think this is going to be a situation where as soon as people go out to restaurants, they're going to stop gaming and the demand falls away. I think this is laying out a carpet for the next few years of really high demand of gaming gear.
Now, I know as a CEO, you can't be fixated on the company's stock price, but I'd love to get your thoughts on what's been happening with Corsair's stock. For a little while, it got caught up in that whole meme frenzy. And I know that according to the Reddit crowd, in June, your company's stock was mentioned something like 860 times. It's been on a bit of a roller coaster ride and is down more than 20% year to date. Given the fundamentals of the company, that seems a bit odd. What would your message be to investors right now, and especially those so-called meme investors?
Yeah, no, it's very straightforward. Look, and I should say, you know, I've been a Corsair investor for 27 years, so one of the biggest private investors. So this is not a stock that you do short-term gains on. And, you know, obviously we're not building the company for the benefit of day traders. But if you invest in a company like this, you invest in the long-term secular gaming growth, the long-term streaming growth, and the fact that we've got an ability to bring out lots and lots of great products. That should be the investment thesis, not what we think, you know, you think the stock's going to be doing tomorrow. So, yeah, so this is a long-term play. And I think ultimately that's gonna you know, play out. Obviously, we've got a lot of things going on between, you know, retail investors versus hedge fund shorting, and that's a battle we watch with sort of vague interest. But the fundamentals of the stock, really, in my opinion, should be based on long-term growth and our ability to win in the market.
Yep, sounds like a novel idea. Corsair CEO Andy Paul, thanks so much for joining us. We appreciate your time.